You do think the market and the economy are at odds here.
Yeah, they are. I mean, look, as Steve was laying out, this is really about the path and the pace of the reopening. Yes, economic demand exists, but that's not the whole story, right? I mean, we do expect there to be a U-shaped recovery, but again, that's not the whole story. The key question that we just don't know is when the economy opens, does it stay open? And does it stay open universally across the United States, or are there parts of the United States that starts to close back down again? This is going to matter in terms of earnings. This is going to matter in terms of default risks. This is the key issue that we have to look forward to. What the market is assuming, and I'm on board with this, is that when the U.S. economy reopens, it's more than likely going to stay open. But I also think it's going to be a slow opening, and that means that earnings and incomes are going to be coming in, but it's going to be slow, and consumption will be there. But again, it will probably be somewhat slow, but enough to get a significant rebound in the third quarter compared to the second quarter. And then the fourth quarter should also show some improvement as well.
Steve, I think it's interesting because instead of the either or of the markets and the economy here, you've come up with a new way to kind of look at equities and credits into COVID cyclicals and COVID defensives. Can you explain what kind of broadly speaking is in each of those baskets?
Well, look, I think it explains a great deal of why large cap U.S. equities, particularly NASDAQ, has done so well compared to small caps in the United States, global equities. That if you think about digital disruptors, e-commerce, which is in discretionary, information technology content, whether this is the provider of video conferences, whether this is software that is running all of these systems, the impact on those industries is really minimal. You combine healthcare and staples, and U.S. large cap shares have the largest component in exactly those industries, by far in the world. And so if you scale down, if you think about energy-centric type of economies, you can see, for example, really just the complete opposite. Why Latin America, for example, in U.S. dollar terms is at a 50% equity decline. So if you basket these different industries, you can explain a lot of what is going on in markets generally.
Sure. So Steve, restate that for a moment, just so everybody's on the same page with you. What do you think explains the fact that Latin America is down 50%?
It's the components, energy, for example, where we've seen jet fuel decline, where we've seen demand for transportation fuels, petroleum. And again, this is for parts of the world, again, in parts of our market, which are relatively small in market cap. Now, it is a higher component of the U.S. high-yield market. But if you think about equities markets generally, other regions of the world have much higher weightings in industries, again, devastated by this impact.
Mm-hmm.
If you take a look inside the U.S. stock market, things like retailing in general, away from e-commerce, travel, tourism, and industrial activity, which is highly dependent on being, physical demand for commodities. Those are, again, COVID cyclical industries. And I'd also throw in something that is normally rather a defensive component, which is real estate. It's not all real estate, but a good deal of commercial real estate covering retailing, covering office space that would traditionally be defensive. In the COVID impact, we think makes it a cyclical weak area.
Right. I'll let you, Jim, kind of circle back to what you would tactically recommend here, whether it's, across equities or across fixed income.
So the best opportunities that we see right now are really across fixed income. And after all, that's what I do. I'm a fixed income portfolio manager. But I would say that it's in the investment grade area because this is the area that has the most policy support. The Fed is supporting this segment of the market. But, as Steve is saying, you've got to be very, very selective. It's not just about buying the index. It's about buying sectors within the index and bonds within each sector. You may not want to have a big retailer that needs a lot of people shopping at one time in close proximity, that might not be the best bet today. But if you buy the index, you might just get all of those different types of strategies. So the way that we think about this is that you've got to be very idiosyncratic, very active, and you've got to be very decision-orientated in terms of what you're buying and what you're putting into your portfolio. It's really, as you know, we like to say, it's a stock picker's market. It's a bond picker's market. And this is the way that we think about constructing portfolios and looking at the post-COVID or the reopening period.
Yeah, bond funds can be tricky at any time, but maybe especially right now. Jim, Caron, Steve Wieting, thank you both for this.